Today's market call is presented by CME Group, where risk meets opportunity. And FactSet, financial data and analytics powered by tomorrow. PM on the East Coast, Guy Adami, Dan Nathan, soon to be joined by the great Carter Worth, of course, of Worth Charting. Market call, Dan, how are you?
I'm doing great. 1 o'clock Eastern, guy. You usually say that.
I thought I did say that. I mean, maybe, well, whatever. It is 1 o'clock on the East Coast. It is August. That's the letter Q. Again, looks like a benign day, but below the surface, some things are happening. So let's throw the rundown up real quick. I love what Amanda did here today. Chart check on gold, dollar, and the Bitcoin. Look at this one. Energy, wait for it, Dan. Running on empty, of course. Homage to the great Jackson Brown. Retail earnings in the form of a couple names this week. And if we have some time, a little audience Q&A.
Yeah, no doubt. It's interesting, Guy, you said under the surface. So yesterday, it was one of those days where if you're watching after the open, it was just kind of flattish. And you and I were saying to ourselves, and we had Liz Young Thomas on the Tape podcast, we're like, maybe nothing really happens between now and Friday morning when Fed Chair Powell speaks in Jackson Hole. And before you knew it, just the market kept on grinding and grinding and grinding. You saw the NASDAQ up 1%. Some of our most favorite names just kept on going and the like. So I just thought that was really interesting action. And it almost feels like the exact opposite here today, Guy, where we opened flat-ish and the market, it's kind of trending lower. We have an S&P that's down, 35 bips. We have the NASDAQ down, 57 bips or something like that. Again, lots of, I don't know. I don't know if it's interesting or not. We're going to hit a bunch of earnings today also. The macro maybe seems more interesting at the moment, Guy.
To me, it does. I mean, there are definitely things happening on the macro front without question. And we talk about that all the time. I know people sort of, their eyes at times glaze over. But, I'll tell you, the market is sort of interesting as well. And I don't know if you want to bring Carter in right off the top, but let's throw these E-mini futures up in terms of the S&P, because what I'm looking at is, look, an obvious trade down to the 200-day moving average within reason. I mean, we got pretty damn close, right? And it looks a lot like we looked, obviously, in November when we broke through it, but then traded back through. People will compare this to what we saw March into April. But, here's what starts to look interesting to me. This bounce has been pretty violent over a very short period of time. Are we going to exhaust ourselves before we get up to those prior highs that we saw in, I guess it was mid-July or so, Dan? And that's what I'm sort of laser focused on. And, that's going to come in the form of a lot of different ways. And we're going to talk about the VIX as well.
Yeah, I just say this, that what's different about, this last few weeks from April, Guy, is, two things. You just mentioned the VIX, the spike that we saw in the VIX on a relative basis, but also just the V reversal, the nature here. So if you look at that VIX again, let's just take out all that crap above, 30 or whatever, right?
Right.
And maybe Amanda wants to pull up a 5-year or something like that. You can just see how kind of out of whack that move was, when it got to 30 and then doubled. It just seems like that, and we've talked about it a little bit, some of the goofiness that went on there. But if you go back to the S&P 500 chart after, let's just look at this VIX here. Yeah, you see that, right? And so if you go back to that S&P 500 chart, I mean, it really was a very sharp V reversal. It got down to kind of support. It didn't get down to those April lows. And I guess the question is, and we were talking about this a little bit on Fast Money last night, is what will be the impetus for it to break out and establish a new range above those prior highs? And again, the economic data, a couple weeks ago wasn't looking so great. It's looked a little bit better over the last week and a half or so. We go from a hard landing, which is what we heard in August 3rd to August 5th, 6th, to what now feels like, again, a soft landing. So I don't know. I mean, thoughts of what would make the market push through, Guy? If Friday morning, Fed Chair Powell is very dovish, and it doesn't seem like for all the bad economic reasons, is that the thing that kind of launches us?
So I guess a couple things. I mean, we're going to talk about retail sales. I mean, if some of these retailers sort of build upon the narrative of the retail sales, and if Walmart wasn't Walmart specific, and if we see that through the lens of potentially Target, that's one thing the market might take some solace. Obviously, you just mentioned Fed Chair Powell and Jackson Hole. The other thing, I think that's pretty obvious to everybody, is what we hear from NVIDIA next week. So those are the three things I think that I can think of off the top of my head. And then you throw in, potential maybe ceasefire in the Middle East. I don't know what the probability of that is, but I think a headline to that extent or to that fact will probably get the market moving as well. So those are the, 3, 4 things that I can think of, just off the top of my head, Dan.
Yeah, so we talked about, the VIX has come in really hard over the last couple of weeks, and it's kind of sitting there on support. It's, right around that kind of 16 level. It was at 15 yesterday, right below that. But let's pull up the 10-year U.S. Treasury yield really quickly here, Guy, because this is something I find pretty interesting. So we're getting back to that kind of 3.8 level. That's what we kind of got below on that August 5th day. And kind of the assumption there was that the Fed was going to have to move very quickly, some emergency cuts. Let's look at the MOVE index. That's the index that tracks the volatility in the Treasury market. And you and I were talking about this earlier. So you've seen that series of lower highs and lower lows, and it kind of turned. You kind of saw some sort of turn. So maybe it's moving back up. It's moving back above that downtrend. And the last one I'll just say is, let's go back to the Treasury market. Let's go back to the yield and look at that multi-year. Let's go to the next one here. I don't know, man. Is that making a head and shoulders? Thoughts here before we bring Carter in, because I know he's got a lot to say about
it. And I want to hear what Carter has to say. I'll say this, the MOVE index to me is what's interesting. If you go back to that, I mean, obviously bond volatility was something we talked about at length most of last year, and for good reason. And things have sort of dampened basically starting in the fall of last year into midsummer of this year. But to your point, things are starting to pick up again. And I think in large part, obviously what we saw a couple of weeks ago in terms of that move in the S&P, clearly that was predicated on the move in yields. But maybe something's going on here. And if you do see this violent move back up, and if bond volatility starts to become a story again, is that the precursor, or is that on the back of something we're seeing equity? So I think we're smart. I think we're right to sort of be ahead of this in terms of what it potentially could mean with bond volatility potentially getting back on its horse.
Yeah, and so this was a call that Carter had been making. We'll let him speak to it. He thought that equities could come down with yields, and he thought, and both of those happened in a very quick fashion, over the last few weeks. All right, so let's bring him in, the aforementioned Carter Braxton Worth of Worth Charting. Carter, how are you, bud?
What's up, man? Good. Yeah, lots going on as always, and sort of a quiet period here, end of summer. Seasonality is not great in August, September, but we have the elections, but we have no more earnings really, but the Fed's out of the way. It's sort of a quiet yet messy moment. We shall see. But some of the main themes continue. Rates continue to go lower, work lower. Equities remain firm with the aggressive sell-off that we saw, and now the equally aggressive ricochet. So we shall see. But you pick your spots and come to your judgments, and then make your bets.
One of the things that you brought forth, people are talking about it now, is what's going on in the dollar. So your first chart is the U.S. dollar. So let's take a look at that. And, you've seen a pretty precipitous sell-off in the dollar. And in large part, I think it's because, what's happening in Europe with the euro. Obviously, we've talked about dollar yen a number of different times. But, this pennant formation, Carter, seemingly is breaking to the downside. And this is something that's been intact probably for the better part of the 3 years. That uptrend for the last 3 years, the downtrend since 2022, it seems to be figuring things out, and it seems to be resolving itself to the downside. So let's talk about this.
Yeah, so tried to start the chart, picking up the COVID volatility. Of course, at COVID's low, dollar, it's a flight to safety. We know yields on 10-year treasuries were basically zero. If you will, dollar spikes as people go to high ground. But the chart is clear, right? Dollar peaked in late 2022 in the autumn and breaking. And it's sort of concomitant with lower yields, higher gold. You can put the pieces of the puzzle together. And while that's not always the case, they do seem to fit here nicely. Oil also a bit under pressure, which is counterintuitive. If weak dollar, that might give oil an assist. But it all smells of less robust times on Main Street, is what it's saying here.
Yeah. Hey, so Carter, a couple things on the dollar. Maybe Amanda can pull up the 1-year chart of the Dixie, right? So that's what you're looking at on a multi-year basis. And, to Guy's point earlier, I mean, to see this sort of move in the US dollar index from It started July at about 106, down here on its way to really 101-ish, and right below that was the December lows. That's a really big move for the US dollar here. And so do you think what's wagging what here? You know what I mean? As far as yields versus the dollar, because I almost feel like with yields now at 3.8% in the 10-year, right? And expectations for the Fed to kind of signal on Friday morning that they're going at least 25 in the September meeting, it almost feels like, the bond traders and the dollar traders and the currency traders are kind of pushing the Fed a little bit. So thoughts on just the extent of this move, you know what I mean, in such a short period of time, and what's leading what in your opinion?
Is that Guy or me?
No,
Well,
I'm
that's the
talking to
thing.
you,
I mean,
Carter.
yeah, please. I mean, look, currencies don't move. Commodities don't really move, right? And when or a big move, unless you have a blight or a freeze, and you can get things like that in small commodities. But basically, big commodities don't have big moves. Really, it's the leverage of the market that makes it seem so big when one's 20 to 1 in the futures account. And the same with currencies; these are slow-moving animals. So, with that said, this is a very pronounced moment of weakness, and it comes with the pronounced drop in yields. And so, which I don't know which one drives which. We know the currency market is much bigger than the bond market, the treasury market. It is the biggest single market. And of course, the US dollar is the biggest single one of all. It is the big kahuna, as the
Yes, it
expression
is.
goes. And there's,
No, I was
go,
going to
please.
say, and you mentioned crude oil. That's obviously one thing, but the other side of this equation comes in the form of gold. And you brought a gold chart too, and that appears to be, and we've talked about this now seemingly for months, if not longer. We built that sort of base. We've had some sell-offs along the way. Each one was met by basically this uptrend line, by continued buying. Seemingly have now broken out of this range that we've been in since, I want to say, I don't know, early this year, February, March of this year, Carter.
Yeah, and so gold has the big breakout at 2,000 an ounce. It was consolidating there for almost 4 years and makes a quick move, as we know, from February of last year all the way to 2,500. We've been consolidating essentially at this level, and now thrusting higher, breaking out again. I think one has to anticipate 29, 3,000, that kind of thing. But it's a very well-formed pattern, and it's very clearly being resolved to the upside. Now, are there false breakouts? Of course there are, but one can't anticipate that. One can only respond to it, act if it's wrong, take measures. For now, stay long, be long, or get long.
Yeah, so Carter, it's interesting, and we want to talk about Bitcoin. We had a guest last night. You were on Fast Money with me from Van Eck, and he, they've issued a couple, Bitcoin ETFs and Ethereum ETF. They also are the issuer of the GDX, and we were talking about that with you last night a little bit. But it's interesting. Your Bitcoin log chart, looks very different. If Vanna wants to really quickly pull up the Bitcoin futures chart, you see a series of lower highs, going back to, let's say, March a little bit. And we know there's been lots of news. There was these, the issuance of these ETFs and the approval of them, and then there was the halvening, right? And you see this thing, it caught a little support at this moving average here a little bit. So walk us through this. And, one of the things that's interesting to me about the Bitcoin is that it hasn't broken out. It's lag gold here. And, Guy's been mentioning this for, a year and a half, is that the Chinese, the way that they've been buying gold, that's been the incremental buyer in the market. But Bitcoin at $1.5 trillion or so is also something that a different class of investor has been kind of working their way into that for probably similar reasons that some people or some institutions buy gold, Carter.
Yeah, I mean, hard to know again what its durability will be. Gold has a lot of history, more as much long as the universe itself, right, so to speak. But in the hands of man as a currency, it has a lot of history as well. Not billions of years, but thousands and thousands. And so the question is, this chart in the long-term chart, there's nothing wrong with this chart. It's just a bit dull, a lot of volatility with no real character. The question is this 4, 5, 6 months of backing and filling, is it normal consolidation? And that has to be the presumption until proven otherwise. And that then brings up the longer term chart, and maybe we can look at that. And so this sideways action, if we see the log chart, it represents what is so well known: when you get to a former high, you back and fill and contend with it. The main thing that I think jumps out here is that, is it all that different than the stock market? Where does it peak? It peaks in December, January of 2021, 22. It goes into a massive bear market in 2022. S&P drops 27, NASDAQ drops 37, it drops even more. It puts in its low at the same time as the stock market, it recovers. And so it is not gold. There is no question about that. Someone say, you're darn right it's not. It's a whole lot better. Okay, that's to be determined. But its volatility alone does suggest it doesn't quite have, or doesn't have at all, the safe haven attributes that gold has.
Before we get out of here, Carter, we talked about crude last week. Let's saw up our crude chart, and Dan and I both thought it was ready to what, Dan?
Party.
Yeah, but the party ended before it started. And here we are. So,
guys, just to be clear, we started talking about it a couple weeks ago, and in the futures, we kind of thought it would get down to those kind of low 70s up from that 80 level. And we talked about kind of trading the double, and we kind of had it. It kind of worked its way back towards 80. And last week, we did highlight the fact that you got to keep moving that stop up, right? You got to keep it really tight. And so I think the story has clearly changed off that bounce, off that uptrend, right? So in a way, one of the reasons why we love detailing some of these kind of future trade ideas is that we have the ability to kind of put in tight stops once we get it going in our direction and lock some gains in, right? Without letting things get out of hand and work their way back to certain technical levels that seem sort of obvious to us if that happens. I mean, I think last week, Guy, we thought we'd probably get back up to 82-ish or something, which was that downtrend line. Does that make some sense to you?
Yeah, it does. And, I thought it would get a little bit more. I thought it had a little more gas in the tank, no pun intended. But, basically what this says, and Carter's talked about this, it's a lot of movement. But, you go back over now a year or so, and we're basically exactly where we started. And I think the problem with crude oil for a lot of people, myself included, is, the moves to the upside have felt like something each time. And then the subsequent moves lower feels like it's going to completely give it up. And people are zigging when they should zag. So, here we are again. I mean, maybe it's worth a try here, but, that old adage of, if we test the lower or upper end of bands a number of different times, at a certain point, something's got to give. And we're at a pretty critical juncture here, I would submit, Carter, in terms of, if you want to continue to sort of trade that range.
Yeah, range trading is very tough. Two things about it: it requires a lot of dexterity, and in most instruments, if one's running real large capital, you can't do it. You can't get in and out. This is very liquid, of course, and you can get in and out. But if we looked like a 3-year chart, just to put in perspective, maybe the peak associated with the Ukraine invasion. We're basically, this is what a pair of twos is. It's always tempting to, and I fall prey to it all the time. So if you were to just white out, there used to be white out on an old piece of paper, but now black out, if you will, since it's a black screen, black out the tops, the Ukraine invasion, and you would just say, well, crude has essentially been 80 at the high, 65 at the low for 3 years. And so the Ukraine invasion, of course, was a one-off, an anomaly, and we can white it out, we can black it out, and we do then see a chart that has a 3-year range, again, 80 basically at the highs, 60, 65 at the lows, and here we are smack dab in the middle. Tough to make hay here.
Yeah, it's interesting. And my 2 cents, not as much on the technical setup, but Guy, you mentioned it before. There's been some stories out in the press that Anthony Blinken is possibly, the Secretary of State, possibly close to getting Hamas to agree to some terms that the Israelis have already agreed. If that happens, and it kind of stems the sort of retaliation from Iran that they've suggested that they are going to do after the assassinations in Iran by the Israelis, then you probably have a little diffusing of some of the geopolitical risk that's kind of embedded in crude. And then the flip side of that, or not the flip side, on the same side, is just the weakness out of China. So if you're waiting for Chinese stimulus to get this thing going again, so I was doing a little bit of the range trade, Guy, with you. Now, if you go back to that sort of 1 year, I know that Carter's calling a pair of twos, but I think it's probably a decent press to the downside. Maybe that gets you back to those 52-week lows, is somewhere down in in the mid 60s. So maybe that's not such a great trade, but we'll see. You know, you can keep a tight stop on that. All right, Carter Braxton Worth, we really appreciate you being here, running us through those charts there. You've been really
You bet.
consistent on yields lower, on dollar lower, on gold higher. You're pressing all those bets. We appreciate it, man.
All right. Bye, guys. Thank you.
Carter's the best. Let's take a look at ExxonMobil because it's interesting. I think UBS slapped a $157 price target on UBS, and one would think that would have got this thing on its horse. It did not. And, you know, here we are. It's a pretty dramatic day to the downside, but we've drawn this pennant. You know, I'm not confident about the downtrend line. I am sort of confident about this uptrend line that's been in place since, I want to say, early June or so, Dan. So we're at pretty interesting levels. That's Exxon, but let's look at the XLE because this is the one that I think we can take our cues from. I mean, this has been in this sort of channel downtrend since the spring, and we're smack in the middle of this channel. Now, the question is, do we touch the lower end of the channel, or are we going to bounce off the 200-day moving average, which comes in the form of about 88 or so? So that's the rub. Obviously, this move lower has been predicated by this move in Exxon. But the question is, are you playing for a bounce here, or do you see continued weakness? And, you know, that's what we're trying to figure out, I think, in terms of the energy space.
Well, it's interesting. Let's kind of go back to that Exxon chart for a second. And I think you and I were talking about it a couple of weeks ago, and it really looked like it was on, you know, the cusp just 2 days ago. You know, yesterday, you know, morning, it looked like on the cusp of kind of making a move towards that prior high. And, you know, on a relative basis to Chevron, we'll go to that chart in a second, you know, Exxon's acted much, much better. Those two names, what percent of the XLE do the two of them combined make?
I think between Exxon, Chevron, and ConocoPhillips, it's north of 41% of the XLE. So obviously a significant portion.
Yeah. And so you see where that 200-day moving average is. If we were to kind of break that uptrend that's been in place, for the last few months or so, maybe that's the level. It's down near those lows from just a few months ago. Maybe that's a level where you reload. I really thought from a technical perspective, and then given what crude was doing when it was up above 80 about a week ago, I thought you'd see this thing break out. So a day like today is really interesting. Let's go to Chevron for a second here, Guy, because this one, you know, just got nailed earlier this month, and, you know, went from just 162 or so down to 140, and it's right here. You know, I think it almost made a perfect match low, Guy, from January.
Well, that's exactly right. I mean, it's a much different looking chart. We obviously cascaded down to those lows we saw earlier this year. I mean, this is the one that I think, you know, if you're looking for a trade, this one sets up pretty well. I think you know what your defined risk is to the downside. And I think you're looking for a move back to the moving average on the upside, if not more. So, you know, I think you're right. We're right in pointing this out. You see the lows that we made recently, and you see those prior lows back in, I want to say, late January or so, Dan.
Yeah, so it's interesting. Let's go back. Let's go to a 5-year chart of this, and maybe your eye will be able to see this. That would be the viewer. I know your eye sees it, Guy. Maybe they can draw an uptrend from those COVID lows in 2020 and attach it to these. Look, it's right through there. I'd actually move it up a little bit. Move it up.
Yeah, that's the line. Yep.
Yeah, and then, you know, you see that downtrend. You can see that with your eyes from the highs in 2022. So, you know, the one thing I just say, Guy, is like, it's kind of a broken chart here, you know, and so
the pennant's been, the pennant's been broken. You know, you've been in this. I mean, if you look at that as a pennant, that's been broken to the downside. The question, I guess, now is, do you retrace back up to the uptrend line and fail? I mean, that would be the worst case scenario where, okay, we've broken through, it does a little work to get back to the uptrend, but then it exhausts itself and then has a pretty precipitous drop. Because if it does that and starts to falter, these lows that we pointed out are not going to hold.
Yeah, and then let's go to the oil services for a second, the OIH, and you know, again, this is a really interesting setup, Guy. If you were to draw a line on a fight, let's draw a line from the COVID lows, and you're going to go through that period in late 2020, and you're just going to attach to as many of those lows. Yeah, and you know, that is sitting, Guy, right on that uptrend, and you know, that uptrend goes. I think it takes you from 75 to a high of last year. What is that, 370 or something like that?
Yeah, and it was a huge move. And you know, what's interesting about the OIH, and not that it matters at this point, but you think about what's been going on in the space. If you do a longer term chart of the OIH, and you know, you think about, you know, this would appear as though this is the all-time high. It's not even close. So
wow.
I mean, it's I know it's sort of apples and oranges a little bit, but in the context of what this thing was a decade or so ago, we're nowhere near.
Yeah, that's a great perspective. I actually, that was not on my bingo card, the long-term chart. And I'll just tell you this, the relative weakness that you're seeing here, I mean, that almost seems like a good press if it's below that support, because this is something that has just been left in the dust, if you will. So again, I think it's interesting what we're seeing between Chevron and Exxon, and obviously the commodity, and it just doesn't seem like there's too many things that are lining up right now, especially if our economy is supposedly weakening a little bit. China's economy has been weak. If we do get a ceasefire, the only good news I can see with crude coming in really hard is that it should kind of be a tailwind for the consumer guy.
One would think, unless it's a function of things slowing down in such a way that it's on the back of the consumer. That's the question that people have to ask themselves. They'll get a relief in the form of energy prices, but is that going to be more than mitigated and offset by what's the slowdown in the economy that we're seeing? And I think that's the rub. By the way, what we've just done here in energy, this, if you're Chrissy's question, Amanda, if you want to throw it up, I think this addresses the question that he had, and we're going to go to Q&A in a second, Dan. But I just wanted to make a point of showing that, this was the question that Chris asked in terms of what's going on with Chevron. Looks like a great area to initiate a position. So there you go, Chris.
Yeah, and so before we get to Q&A, guy, let's hit a couple of retailers really quickly. I think you and I were both kind of surprised when you see a company like Lowe's, kind of miss on a couple metrics, have kind of, cautious guidance or so. Yeah, the stock's down a little bit, 1.25% or something like that. But, you'd think it would be given a little bit more back, maybe that sort of 200-day moving average down there at 225 would be in play. But it's interesting to me that investors are willing to give it a pass. Not too different than Home Depot last week.
Well, that's exactly right. Not too different than Home Depot, but it's the commentary that I think you want to focus on, because although the stock is hanging in there, to your point, and actually Home Depot, which said very similar things, the initial reaction in Home Depot was lower, and then that stock reversed higher. So I think what you're seeing to a certain extent is a relief rally on these names, maybe on the back of valuation, and maybe on the back that it wasn't as bad as the market expected. I think that's the two things. But with that said, the commentary out of these two, and you layer on top of what you're hearing from Walmart in terms of the trade down that they're seeing to them, and then other retailers and other restaurants, and it all is part of a narrative that we've been talking about for quite some time. Without question, things are slowing down.
Yeah, so it'll be interesting to see what Target has to say tomorrow morning before the opening. They report implied move about 7% in either direction. It's interesting, though, Guy, that we had, that gap up, 2 quarters ago, and the stock was, kind of moving higher in step with Walmart. That's not something we've seen in a row, but that was 2 consecutive gaps higher. Then we had a big gap lower 3 months ago. The stock got hit really hard, right, when the consumer weakness or the perceived consumer weakness became, a focus after that initial jobless claims. So here we are now. You see that 200-day moving average we just failed at. Tomorrow, like, I don't think you're expected to hear too many similar things of what you heard out of Walmart that powered that to new 52-week and all-time highs.
No, I don't. And if I'm wrong, I'll say it tomorrow. But, that gap, that upside gap that we created back in the fall of last year into the winter is sticking out like a sore thumb. And, if you go back and look, the gap that was created in February into March of this year was subsequently filled to the downside. There was a gap that was created to the downside back in May that was filled when you saw the bounce into June. So you have all these gaps in the charts that have been filled, and the one that sticks out and the one that was made last fall. And I'm not saying we're going to fill it tomorrow, but what I will say is, I look at Walmart and then say, man, oh man, they are seeing not a resurgence, but continued movement to their stores. And is it a zero-sum game in retail? And when I talk about zero-sum between Walmart and Target. And if in fact that is the case, then I think what you're going to hear from Target is going to disappoint some people. That's just me reading the tea leaves. So we'll see how it plays out.
Well, it's funny, and I know it's a relationship you've looked at in the past. If you just look at the multiple on Walmart at about 30 times this year and 27.5 next year, it's nearly double of that of Target. And so for people who kind of get sucked into that sort of thing, and you say this all the time, some things are just cheap for a reason, right? And they just end up being value traps. So it's interesting to see if, listen, they don't have the reliance on obviously grocery, and that's been a hot spot to kind of draw people into Walmart. All right, one other name, and this is kind of consistent with the Walmart theme, is kind of the trade down that we've seen, to Walmart. And maybe that's, in apparel, we're seeing that in TJX a little bit.
100%.
Reporting also tomorrow before the open, a 4% implied move in either direction. The stock's up 20% in the year. I think you'd probably say, given the share that they've been able to take in apparel, that where it's trading on a multiple basis, 27 times this year, 25 times next, it's not egregious. It's a little high for this, business, but thoughts on TJX into the print?
Yeah. So I'll say this, and if I'm wrong, we'll talk about it tomorrow. But I think this is one that will continue to sort of surprise to the upside. And you've seen a recent sell-off from the middle of July. I think that was an all-time high. Sold off marginally, probably on the back of that broader market move, but it started picking up again. I think this is one. This is, if you think about the world we're in, this is Walmart's world, and to a certain extent, it's TJ Maxx and Costco's world as well. And those are three different but similar businesses, and the charts are going to look very similar in terms of what they've seen. And on the flip side, who's losing, and it's, it doesn't make a lot of sense. It's somewhat counterintuitive, but the dollar stores are really not picking up the way you would think. So, we'll see. I think TJX is going to surprise to the upside. I think we take out the prior highs that we saw a month or so ago.
Yeah. So interesting to me, Guy, is that, it's had a huge move, right? So it bounced off of that, that 200-day moving average. That was back in the spring. So during the throes of that sell-off, which was 6.5% in the S&P 500, this sold off, I don't know, nearly 10% or so. And look at that move that it had. It's just unabated, right? From the April lows, and it was probably at 23% or so. And so I just say to myself, listen, if they can't say anything good about back to school, or it's not as good as some people would expect, I don't know how you buy this thing to make a new high above 115. It just doesn't seem like a great risk reward into the print. So
fair. Listen, all fair. And again, we say it all the time. That's what makes markets, and we don't always agree on these things. But I will tell you, the Target report, I'm really interested, because if you look at Walmart, they've really figured out their inventories are obviously operating really well. Good for them. And by the way, I'm not a huge AI person, but I will say that if you read through what Walmart said, I mean, they seemingly are starting to figure it out on the AI front a little bit, and that's manifesting itself in the margins. Question is Target doing the same, or are they being left sort of in the dust, as they've been left in the dust for quite some time? So I'm really, there's certain things you look forward to, sporting events. The Target report is something I'm looking forward to for sure.
All right, very cool. Should we try to take 2 questions?
Yeah, Alibaba's one, Max P. Why won't it just break out? Good question. I've thought for a while, and it looked like a genius for a while, not so much. But when that stock sort of got down to 68.70 or so, I'm like, all right, this is going to be setting up for another one of these moves higher. And in the spring, here's a stock that went from basically 68 to 90 and almost in a straight line. And I was feeling really good about it, because I thought we were on the verge of seeing another one of these 50% moves or thereabouts in BABA. Didn't get it. Pulled all the way back. Why isn't it breaking out? Good question. I think there's obviously concern with what's going on in China. And I think this last quarter was such that it didn't really get people excited. That was about a week or so ago. But, if you look at Alibaba, which, by the way, has been in a pretty steep downtrend for quite some time, along the ways we've seen, 35 to 60% moves off lows. And I think we're sort of setting up for another one of those. It doesn't look like it's going to happen, but I'd rather play at $81. I think that's where it's trading right now. I'd rather be playing Alibaba from the long side than the short side.
Yeah, so we spent some time, over the last couple of weeks just talking about the just flat out weakness that, the Chinese economy is seeing. It's consumer led there. And, when you think about this stock in particular, it's not just retail. It's kind of a similar story as Amazon in a way. They have this big cloud business, but, the issues that they have is that, Amazon does not have a firewall, right, on their country and who can use it. And I look at the kind of analyst ratings on this: 44 buys, 8 holds, no sells. And the stock, to your point on that 5-year, it's had a nice little bounce off the bottom of this year. But, it can't get out of its own way. I mean, that is, and it trades at 9 times earnings, guy. Good balance sheet. Obviously, if the government starts to stimulate over there, it should be okay. The last thing I'll just say about Alibaba, and we've talked about this on Fast Money a little bit. I mean, Apple just introduced this Apple Intelligence, and they're hoping that this is going to be a huge boon for them, as an upgrade cycle. If they are going to introduce that product on iPhones in China, they're going to need a local, cloud provider, a cloud partner. And so that could be Alibaba. So that could be something to kind of keep an eye out for.
John Doe. Hello, John. The last 2 years, October was a bottom. Is this statistically common? Should we sell and buy back in October, or did we already bottom out on August 5th? I'll say this, I'm hard pressed. This is just me. I'm really hard pressed to believe that move we saw a couple Mondays ago was it for the year. I think it was the precursor of something. Again, I'd be shocked if that VIX was a one-day event. The fact that we've bounced the way we have is obviously great if you're long, but concerning the speed with which, and if we start to sort of falter here and run out of gas, into September, historically, things get a little dicey. So, I'm one that thinks, this bounce has surprised me, although, I thought we could bounce, but not to the extent that we have. But, I think it's going to get exhausted here, Dan.
Yeah, just the last thing I'll say about this on the broad market is that we know that next, Friday, the Fed's going to kind of give some sort of indication about what they're probably going to do at the September Fed meeting. It's at least 25 basis points. You and I have talked to some people who said they don't think they're going to do anything. You don't think that they should do anything right now, given some of the data. And so when you think about that, you see the CME Fed funds tracker and what it's pricing here. It's near certainty, right, that we're going to get 25 basis points. But, between Jackson Hole and the Fed meeting, we're going to get, the jobs report the first week of September for August. We're going to get revisions this week for the last year or so, and then we're going to have CPI. And so, it'll be interesting, Guy, to see how much that has the potential, that CME Fed Fund tracker, to change over the next few weeks or so. So, we started out the show by saying, what is the thing that would kind of bust this out to the upside and establish a new range? And make no mistake about it, with that sharp V reversal, if we start to make new highs and get to like the upper bounds of an uptrend that you could draw, let's say from the 23 lows, it's getting steep. You know what I mean? Even with that little bout of fear that we saw a couple weeks ago. So to me, the idea that maybe most of the gains are in for this year makes a lot of sense to me.
Buckle up, people. I do think, we thought this be a pretty benign week, and you've seen some movement in some individual names. We talked about energy and stuff. I think the VIX might have just put in a short-term bottom. So I think there's still a lot to happen for the rest of this week, but we will be back tomorrow. But before we go, Dan, what is this week? 15? I've lost track. That's how long we've done it now.
We love it. It's the Market Matrix. This is a podcast that we introduced maybe 15 weeks ago, Guy. And it's a AI generated podcast. Our team curates what we think are probably the 10 most important stories in business and in the markets. And we just basically get it summarized by Perplexity. We put that text into a voice bot. You don't have to listen to Guy or me. You just listen to this thing in under 10 minutes and get up to speed with what's going on. So check it out, MRKT Matrix. It's in your favorite podcast store. Follow it, rate it, review it, share it with your friends. That's how people find it. So thanks.
Why wouldn't you? Tomorrow we're back with EYT, no longer EY from SoFi, but just EYT. We're looking forward to that. And enjoy the rest of the day, folks. Yankees are, I think, at home against Cleveland. I might be mistaken. I have to check that out. The Mets pulled one out of their rear end last night. Good for them. We'll see you tomorrow.
See ya. Thanks.